This presentation is entitled Sales Transactions, Merchandising Business Inventory Recording. We will be learning about the details regarding sales transactions. First, let's look at perpetual inventory. What is perpetual inventory? Perpetual means ongoing, continuous, without stop. When we use a perpetual inventory system, when we make a sale, we record the sale as a sales transaction and we add another journal entry to record the inventory. So you see we have each purchase and sale is recorded in inventory and cost of merchandise sold accounts. This becomes a single line on the income statement, cost of merchandise sold, or cost of goods sold. You can take a look at an expanded income statement in the document that goes with this module. Another key vocabulary is revenue recognition. Let's see if you can follow along and determine what revenue was really earned on this sale. Assume a retailer sold $100 in merchandise to a customer on account. The customer returned $10 of the merchandise. The customer also paid the remaining merchandise early, entitling her to a $5 discount. What amount of revenue was earned on this sale? Well, I hope that you had figured out that perhaps we had a $100 sale minus the $10 return to give us $90 due, and then the $90 had a $5 discount applied, which means this particular sale had the revenue of $85. Very important concept. Look at this slide closely. For merchandise, when we record the sale of merchandise, there are two entries for the single transaction of the sale. We record the revenue of the sale and we record the inventory piece of the sale. Let's take a look at what that means. Here's an example of a sales entry. Notice that I have cash and sales at the top. This is to record cash sales. What am I getting? I'm getting cash. That's my debit. And sales is my revenue account, and that's a credit. The second piece, right here, deals with the merchandise inventory in a perpetual inventory system. We are debiting the cost of merchandise sold and crediting merchandise inventory. If you remember, inventory is an asset account, and asset accounts have debit balances. Well, we have some amount of inventory in our inventory account when we sell it, and we need to remove it. And so to remove it, it's a credit. This continues with each sale we make, and so that the inventory account is brought down as we make sales, and the cost of merchandise sold account goes up. Why? Cost of merchandise sold is an expense account. It is the expense account that goes with what we pay for our merchandise. Let's take a look at another example. Sale of merchandise. Sold $500 in merchandise to a cash customer. The cost of merchandise sold was $280. Remember, this is a two journal entry for one transaction. What is our one transaction? Sale of merchandise. We record our sale. We have cash and sales for $500. The second piece, we record our inventory. Cost of merchandise sold, $280. Merchandise inventory, $280. Again, this is our sale, and this is our inventory piece. Now we're going to look at how we handle sales returns. Let's start with an example. Accepted a return of $50 worth of merchandise from the cash customer in prior example. The cost of the merchandise returned was $30. The customer received a cash refund. Again, we're still in perpetual inventory, and so anytime we have a sales-related transaction, we have the inventory piece. To return sales, we are going to debit sales returns and allowances, $50, and credit cash, $50. Remember, we're giving the customer back cash, and anytime cash is going out of our business, it's a credit. The second piece is, what is the cost of that merchandise? Well, the cost of the merchandise, they said, is $30, so that's our inventory piece. Notice here, we are debiting inventory and crediting the merchandise sold account. This is opposite of a sale. That's exactly what we want with a sales return, because we're putting it back into inventory. So we're going to increase our inventory back, and we're going to reduce that expense account because it's no longer sold. Let's take a look at sales discounts. What is a sales discount? It's when I pay less for what I bought. There are some terms of sale with regards to sales discounts. Right here we have the term 210 net 30. What does that mean? What it means is I can get a 2% discount in 10 days, or I need to pay the net amount in 30 days. So what does 315 net 30 mean? If you said 3% in 15 days and net in 30, you are correct. Accounts receivable customers receive a discount if paid early. Let's take a look at how we journalize for sales discounts. Let's follow along. Sold $3,000 in merchandise to a credit customer on a store account. The terms of the sale are $120 net 30. The cost of merchandise sold was $2,400. First, we're going to record the sale. We have accounts receivable and sales. Accounts receivable is an asset account with a debit balance. We're increasing it. And sales is our credit revenue account, and we're increasing it. Then we have our second piece, which deals with the merchandise inventory. So we are going to reduce our inventory account with a credit, and we're increasing our cost of merchandise sold, which is our expense account. Same as before. We're going to assume now that we received the payment from the customer within the discount period. What is that discount? How do we calculate it? Well, the discount was $120 net 30, and as we saw before, the 120 means 1% in 20 days, or all of it in 30 days. If we are actually receiving the money from the customer within the discount period of 20 days, we're going to take 1% of $3,000. Their discount is equal to $30. How do we make a journal entry to record the receipt of cash? Well, how much cash did we receive? We received the $3,000 minus the sales discount of $30. So the cash the customer sent us was $2,970. Their accounts receivable account had a debit balance of $3,000. I must make their accounts receivable account a zero balance because they have paid us according to the terms of the invoice. When you look at the T account, you can see immediately, what do you need to credit their account? You must credit it $3,000. So what's the difference? Well, that's our sales discount. Pause this video here and work the following 4 transactions as you have just seen them demonstrated. Come back when you're done so that you can check your answers. How did you do? The solutions are in the solution document. Please see how you did. This ends this lesson on sales transactions for the perpetual inventory system.